Okay, well, joining us now on our closing bell exchange, Winnie Sun from Sun Group Wealth Partners, Cliff Davis from BNP Paribas, Rob Morgan from V2V Associates, Doug Gordon from Russell Investments, and of course our very own Rick Santelli. Winnie, do you think the selling is over for now? Is it onwards and upwards, at least in the foreseeable future?
Well, the S&P has nearly tripled since March of 2009, and so we're really happy with this, analyzed over 19%. Today's data with payroll, we felt really good. So, you know, we believe right now is a time to restructure. Cash is your friend right now in this market. We gotta have some cash to get ready for opportunities.
So you're pulling some money off the table, Is that what you're saying, Winnie?
Well, we definitely want to take some, you know, it's time to trim your tree. We want to take some money off the table to get ready for opportunities, you know, get mentally, financially ready.
Winnie is trimming the money tree.
Yes, she's trimming the tree. There's still only 82 days left until Christmas.
Yeah, I just heard Jan say that. Hey, Cliff Davis, what are you doing with this market? What did you make of the jobs report, and do you think it's all systems go back to the upside?
Well, you know, this was just the information the market's been waiting for all week. All week, there's been this geopolitical tension. Everyone focused on Hong Kong. Everyone focused on Ebola cases now in Texas. But what we saw, we came in, we had strong numbers ahead of consensus, and the market just rallied. You know, S&P's up 25 points on the day. VIX, the fear index, which is what I watch very closely, is down 1.5 points. Right now, we're cautiously optimistic, and we continue to have a 2,000 S&P price target for the end of the year. We continue being bullish, but we're telling ourselves, let's think about where we might go if some of the geopolitical tension should heat up. Overall, though, what I'm really positive about is the fact that unemployment rates have come down to 5.9%. And just reading some of Chairman Yellen's comments, she's also indicated that since 2008, it's really been slowly declining, the unemployment rate, and that's really a positive sign.
If you've got a 2,000 target on the S&P, I mean, it's currently at 1970. It's really only 30 points away from now. So that's not wildly optimistic. I mean, you really only need another good day like today, and you're almost at that target. But, Rob, I want to bring you into the conversation. Just moving away from Goldilocks and all this bullishness that's going on right now, what could stop this in its tracks? What's the biggest fear for you right now?
Well, the biggest fear for me, Mandy, and I will say I'm pretty bullish myself, but my biggest fear is that the retail investor is finally starting to get back into this market, and of course that is a big contrarian indicator. Now it did take the retail investor the first 4 years of the bull market to pull out $500 billion from equity mutual funds. So just the fact that this is starting now, it's going to take some time to develop. But that's a concerning sign for me. But at the same time, I'm bullish. The earnings season's going to be great, and I think I think 2,000 by the end of the year is certainly doable, if not on the low side of expectations.
Rick Santelli, you were telling us yesterday, you guys in the bond pits were watching the stock market, and that turnaround we saw yesterday began around noontime. We had been down 130, and then things turned around, and we continue this rally. What do you make of it? And you know, the strong dollar is still there. Oil and gold are getting slammed as a result. What's this market telling you right now about their expectations for the economy?
Well, I think on the expectations for the economy, you could look at 10s or 30s. 30s are actually down a basis point today. Where you're seeing the real issue is in the 5-year on the curve flattening trade. 5 years are down about a half a dozen basis points, or excuse me, up about a half a dozen basis points in yield today. Why is that? I think that the data, and we could argue, you know, 92.6 million not in the labor force is a new record. I don't know who's going to take care of those people, but it's not going to be cheap. But having said that, it was better than expected data. The drop of below the 6%, surprising. And I think all of that is improvement, no matter how granular you want to get. But I think the flattening yield curve gives us a very good idea that zero interest rate policy needs to come to an end. We all know that the QE is coming to an end, but I think in terms of a market, when is the equity market going to die? It's going to die when the Fed balance sheet shrinks. I think that's the easy answer. And anybody who doesn't believe me, maybe they saw the chart today we used, but if you put the S&P 500 on top of the size of the Fed's balance sheet, the correlation is uncanny.
You were saying that, zero interest rate policy, ZIRP, in other words, needs to come to an end. When do you think it needs to come to an end, all things considered? Rick?
Probably a meeting or two ago, in my opinion. I think, I'm not talking for a 4% rate. Maybe we'll never get to 4%. I don't have a problem with that. But I think we need to get it up towards 1.25%. Start slow, maybe just do a 25 basis point. We need to wean the market off of being led by the nose by a Fed who's trying to be transparent on something they don't know the outcome of yet. And I think that's created some very negative dynamics. If they're going to be data dependent, why can't they be flexible? Raise rates to a low but higher than zero level, and if the data's better, you raise it a little faster. If it's slower, you bring it back down. What is wrong with that? It makes no sense to me that they can only go in one direction one time.
Yeah.
That's a good question there. Doug Gordon, we haven't forgotten about you. We've been asking our viewers if they think the selling is over at this point, and we're in a dead heat right now. Literally 50% say yes, 50% say no. What do you think? What do you make of the mood of this market and the sentiment as the volatility has picked up again here in the last few weeks?
Yeah, and I think that volatility, Bill, is just going to continue. When you've got the Fed in this world where they're going to be data dependent, they're not providing the market with what it really craves, which is certainty around time, amount, and pace of their action. That said, though, the other side of this, with the Fed being data dependent, gives them the highest likelihood and probability to move in lockstep with the pace of recovery of the economy. So I think that's where the focus is going to be, and we'll have to watch rates as they go forward. So volatility to go forward, but we still think the path of least resistance is higher with respect to equities and certainly higher with respect to rates, albeit maybe in a slow pace.
Well, we certainly hope it's going to slow, gradual pace, one that the market can handle. But back to you, Winnie. You were saying that you're taking a little money off the table. Where are you taking profits from, and what do you want to buy? What are you keeping your powder dry for?
Well, we really do like these markets. I mean, the S&P is sitting on $3.59 trillion of cash, so we're comfortable, but on the same token, we do believe in rebalancing. Cash is certainly your friend in this market, so it gives you an opportunity to take advantage of weakness, because weakness is important. And so that's something that we're embracing right now.
Weakness is important. I love that. When we see a really big down day, people are like hand-wringing and saying the market is selling off. At the end of the day, it creates a buying opportunity. All those people have been maybe missing out on everything and wanting to get in.
We can't all be bullish. Cliff Davis, what are you going to buy from Winnie? What? You still feel we're headed to 2,000 by the end of the year on the S&P? What's going to take us there?
I really like retail. When I focused on the job numbers this morning, if you look at it, a lot of those numbers are coming from not goods but services, and the service industry, namely retail industry, is really picking up. So I like names like the Gap. I like anything to do with retail product. I think the community and the American public is going to be putting more money into the holiday season. So that's really the area I'm most bullish in.
All right. Thank you all, folks. Appreciate that. And